We'll be starting in next 8 minutes approx.
Yeah. Hello, Professor Walters.
Hi, Avashi.
Hi, Avashi.
No, this is Dr. Shikha here. I just dropped in to say hello.
Ah,
Yeah,
Are you-
now
are
you
you-
can see me. Yeah, now you can see me.
let me get
Let me
rid
get
of
rid
my.
of my.
Ah, there you go.
Thank you so much for joining us today.
Nisi, it's a pleasure.
Um,
How are you?
Good, good. Difficult times, but we all are surviving.
Ah, I see that. That Gandhi is looking over you.
Oh, yeah. He's looked over many Indians for generations. Yeah, he was the biggest influence to my mother's life, and that passed on to me.
Yeah, I was fortunate enough to study when I was in Cambridge. Before I became a lawyer doing history,
Right.
I studied under a gentleman called Anil Seal, who was Kashmiri.
Oh, of course, I've heard his name. Yeah.
And so I took a class in basically in the sort of about the run up to 1947 and the partition, and so all of the characters from that era, obviously including Gandhi, also Nehru, Vallabhai Patel, Jinnah, all these folks, all these important folks. So yeah, I was able to learn a little bit about your country, so it's good.
It's so good to hear that. So I think India's independence war is still very recent in history, and I think people of my generation earlier, each family would have someone or the other who have participated, at least if not directly, then indirectly in this freedom movement. So there were two types of movement going on: one on the borders with the forefront, and then there's a freedom of movement going in the minds of many Indians that how should they achieve it and what should they do once they achieve it, because it was not just they're fighting with the British Raj, but they were also fighting with a lot of thoughts, because not every Indian saw a British Raj as a culturally they saw a lot of growth in them. Of course, there were a lot of atrocities that all of us spoke against, but culturally, the kind of mix that India got. So I was reading a very nice book by forgetting his name. He's written about the positive of British Raj. So I think it's a very different perspective of looking at how culturally many countries evolved.
Right, it's interesting. I mean, obviously, I'm originally from the UK, so and as you say, I mean, certainly there is a very, I mean, the moment in the UK, there is a harking back to the sort of glory days of the empire, which is part of this narrative of sort of British exceptionalism and greatness, which I think several of us would push back against.
Yeah.
But I guess, for example, I mean, one thing that India does have, is a common law system, which I think in many ways it can be a very helpful kind of legal system to have developed. So as you say, I mean, there may be certainly a positive legacy, as well as, if one thinks about sort of mass migration like that was happening, and all the communal violence that was happening sort of in, well, it goes on today, right? It's not stopped. But certainly sort of around about 47, 48, there were
I think
we scuttled out and left chaos in our wake. Is the other part of the story, right?
So I know, as I see, is that there was a lot of divide in India happened, but if you look at Asia, the Asian business landscape or the legal landscape, somehow it did connect one Asian country to the other. So I think this cultural linkage with Asia, it sort of strengthened because of the common law system. So of course
Right.
there were home issues, but culturally what we celebrate today is uh, intended, unintended effects of the Raj. Yeah, but so we have participants already joined in, and Dr. Walters, I would like to let you know that Urvashi, she's a senior research fellow and she spearheads Friday Talks. And so I'm gonna hand it over to her, but before I hand it over to her, I must express my gratitude for you, towards you for joining us. Um, despite 12 hours difference, you could really make up, and you committed yourself to this webinars. Thank you so
Right.
much.
I'm very, very pleased to be joining you virtually, traveling virtually to India. It's a fascinating and challenging time, as you say, and also, obviously, it's been a very interesting time in India these past several years, or last 2 or 3 years at least, with the adoption of the Insolvency Bankruptcy Code in 2016, and I think the sense really that India has joined the mainstream when it comes to thinking about insolvency and restructuring. So at this point in that part of your evolution, with the interesting, exciting programs that you have going on in your institute within the Ministry of Corporate Affairs, I was very, very happy to accept the invitation, and hope I can say something useful to you in the 45 minutes or so that we have.
Thank you so much, Professor Walters. And I see Professor Omar is also here. Professor Van is here. So I think Urushi, we have a great list of attendees. I see. So I hand it over to you, Urushi, to take this forward.
Yes.
Yeah, thank you.
Good evening and a very warm welcome everyone to the Friday Web Talk series. Today we have with us Professor Adrian Walters, who has been a professor of law who is a professor of law at Chicago Kent College of Law and also a visiting professor at Nottingham Law School, Nottingham Trent University. He is a very acclaimed thought leader in the field of insolvency. And today he'll be speaking about COVID-19 and distressed business, and particularly American response to the implications in insolvency regime in US. So, welcome, Professor Walter. Just before I hand it over to Professor Walter, just few rules for the audience. That I'll request everyone to keep your microphones on mute till the talk is going on. Last 20 minutes are reserved for question and answer, and you can use the chat icon in the right panel, or you can use the raise hand icon to directly share your audio and ask questions directly to Professor. So I'll not stand for long between you and Professor Walter. Over to you, Professor.
So actually, thank you very much indeed. And as I've just been saying to Niti, it's a great pleasure to be traveling virtually to India to be with you. And thank you very much for accommodating me. I know that you're already into the evening in India. It's very helpful to me, given the sort of 11.5-hour time difference, that you have not dragged me out of bed too early in the morning. It's 9:02 in the morning here in Illinois. So thank you very much for accommodating me. So when I was contacted, and I understand you've been doing this a little bit, obviously with COVID-19 at the forefront of everybody's minds right now, I think you've been traveling around the world a little bit and hearing about various different responses. I thought I would give you something of a snapshot of the impact of COVID-19 here in the US, and particularly its impact on distressed business, and to look at what the responses have been to that, especially in the area which we're interested in of insolvency and restructuring law. And I guess I would preface all of that by saying I think where we end up, or where we'll end up once I finish speaking, is with a picture that for now, in contrast, I think, to many jurisdictions, what America has been doing is, for the most part, emergency economic measures. And as we'll see, there hasn't been too much done legislatively, or not much at all, in fact, legislatively, with the US Bankruptcy Code. So perhaps there a little bit of a difference from many jurisdictions, including, of course, India, whereas I understand your changes to the code, you've been raising thresholds and trying to restrict access to the bankruptcy system and to sort things out in other sorts of ways. So let me just click the slides. Some of these slides, you'll have to forgive me, have sort of got a little bit scrambled within the LMS platform. But first, just a little bit of an idea about the impact of the public health crisis. So as of 3 days ago, there had been more than 101,000 deaths from COVID-19 in the US. And there has been a skewed impact. So metropolitan areas in New York and New Jersey, in particular on the eastern seaboard, have been worst hit. So New York City accounts for something like, roughly 20% of the deaths. In metropolitan New Jersey, just the other side of the West River, there's another 12,000 have perished. And so the whole sort of NYC, metropolitan New York and New Jersey area has accounted for, certainly as of June the 16th, roughly 1/3 of the mortality. Now, that has led, this being the United States, as I'm fond of saying, there are many Americas, to a certain degree of variable response, and a sort of sense in some parts of the country that this really isn't our problem. And what we're now seeing is numbers rising, particularly in the Sunbelt states, states like Arizona and Texas and Florida, so the large and populous states. And so, as some people are now saying, it's all well and good talking about a second wave, but the first wave isn't over yet. So there is a big problem here in terms of the disease itself. So that's the basic picture in terms of COVID-19 and its public health impact. The public health response has been highly variable. States have generally followed a flattening the curve policy involving some combination of non-essential business closures, shelter-at-home orders, lockdowns, and travel restrictions. But that has been patchy. There have been some states that closed their non-essential businesses but really did nothing else. States like Arkansas and states like Iowa, states like the Dakotas. And similarly, state-by-state exits from the lockdown are also proving to be highly variable. I am sat in a state in Illinois where Governor Pritzker has been very consciously pursuing something along the lines of a South Korean type of strategy, aggressively locked down, phased exit, increase state capacity for testing and contact tracing, so that as you come out, you can isolate further incidences and tackle them and know what you're dealing with. That's been very much the strategy in Illinois. But round and about Illinois, in the other neighboring states, all the other Midwestern states, so Wisconsin, Indiana, Michigan, are now fully open. So even here in the Midwest, I mean, to be honest, Illinois is something of an outlier, and perhaps that's a blessing for those of us that live here. Certainly, sort of on my view of things. So, as you might imagine, many Americas, differential responses. We're going to have to see how that all plays out, and this side of an effective treatment for severe cases of COVID and/or a vaccine. The story on that is likely to continue. as far as one understands what the epidemiologists are telling us. So what about the economic impact response then? Well, the federal government has responded very aggressively, and on this slide I can talk through a number of those federal responses. The major response comes through something called the Coronavirus Aid, Relief and Economic Security Act, the so-called CARES Act, that was signed into law by President Trump on March 27th of 2020. And under that act, there has been a $2 trillion package of emergency economic relief, broken out into a series of different funded measures. So there have been payroll measures, or payroll tax credits, deferral for businesses in accounting for their payroll taxes, designed to encourage continued employment and to reduce the cash flow impact of COVID-related closures. There's been also a considerable attempt to provide small business relief. So it's often said that small business is the backbone of the US economy. There are studies and numbers out there from the Bureau of Labor and these sorts of places that suggest that 40% of GDP is accounted for by small business, and there has been therefore a considerable attempt to inject liquidity into small business. Of those, perhaps the most famous, most notorious, most well-known program is the so-called Paycheck Protection Program, which I'll say a little bit more about later. And under that program, essentially it's a loan program, but the loans, as long as you play by the rules, are forgivable. But as we'll see, only eligible businesses, only businesses that satisfy certain criteria in terms of size, qualify for paycheck protection relief. There's also been an expansion of the already existing economic injury disaster loan program. That's a program administered by the Small Business Administration, which is a state agency, and that is normally the program which kicks in the event of a climate-related disaster. So Hurricane Katrina, Hurricane Sandy, when those happened and those impacted and interrupted businesses, it's that program that is usually deployed to support businesses through those sorts of events. So that's been expanded to add COVID relief to it. There's also been considerable federal and state initiatives providing for mortgage and rent forbearance to sort of stop the clock running, to stop the payment clock running for debtors either on their mortgages or where they are in rented premises on their rent payments to landlords. So that's the small business relief packages. There's also, of course, been considerable intervention from the Federal Reserve and the US Treasury to inject liquidity, particularly into business sectors that have been severely affected, such as the aviation sector. So a very wide and aggressive and reasonably swift economic impact response. And just by way of comparison, I think the numbers that I've seen out of MIT in terms of the overall direct costs of the federal response to the financial crisis of 2008, when that all washed out, is estimated the cost was somewhere in the region of 500 billion. So you can see this is on an altogether larger scale. So let me say a little bit more about the payment protection program. My interests, particularly these days, are more on the small business side than on the mega Chapter 11 side of the ledger. So I've been keeping a close watch, in particular, on the payment protection program. And there's been some interesting litigation in bankruptcy courts about it, which I'll say a little bit about in due course. But this is the shape and size of that program. Initially, what happened was that the federal government, through the CARES Act, pumped in 349 billion to be administered by the Small Business Administration, this federal agency. And the way it works is that they partnered with the major banks in the banking system. So participating banks can qualify for some of this funding, and essentially what it amounts to is federally guaranteed loans through the banks. So there's an encouragement to the loans to make the advances on the basis that if it all works and the loans are compliant with the rules of the scheme, then essentially the federal government is underwriting those loans. So it amounts to sort of pump priming, a system in which those participating banks that make the advances will get those monies back through the system. It's only businesses with 500 or less employees that are eligible, and there are rules in place to ensure that businesses can't game the system, by saying, well, this entity within the group has less than 500 employees, that will apply, not taking into account employees in affiliates within the group. That won't work. So if you're part of a group and the group as a whole has more than 500 employees, you won't be eligible. So it's very much concentrating on small groups or single entities, that sort of thing. Loans through Payment Protection Program are capped at 2.5 times, a multiple of 2.5 times the average monthly payroll for 2019, so before the crisis hit, or 10 million. So if when you do you apply the multiple to your monthly payroll, it comes out at above 10 million, then you're capped at 10 million. And there are or have been strict rules about how the Payment Protection Program loans can be deployed. So they can be used to cover payroll, rent, mortgage, utilities, and originally it was up to a 2-month or 8-week period. And if you use them in that covered 8-week period fully in accordance with the rules, then the loans would be or are completely forgivable. They can be forgiven and effectively written off. But one of the issues with the Payment Protection Program in its first iteration was that there was a rule you had to use 75% of the monies on payroll. The idea being that we wanted to keep the employees employed, keep the employees remunerated, so you didn't have a spillover into the wider economy. So to try and create some sort of hibernation, I guess. But of course, there are many businesses, many small businesses that operate with few employees, or they operate with what we call 1099s, which are essentially independent contractors who are not on payroll. And of course, there are lots of know-how businesses, that deploy intellectual property and don't actually have that much of a payroll, and for whom it was much, much more important to be meeting the rent payments, meeting the utility payments, and so on. So it was quite a rigid scheme originally, and that caused some problems initially with take-up. If you use the monies in ways that don't follow the rules, including these rigid rules about how you can deploy the monies, then the loans won't be forgiven, and you will then effectively have substituted a 2-year loan, 2-year maturity on the loan, but at a reasonably generous 1% rate of interest. So play by the rules, the loan is forgivable. Deploy the monies under the rules, the loan is forgivable. Go outside of the rules, then for that portion that's outside of the rules, you're on a 2-year maturity with 1% interest. So that's the payment protection program. Now it quickly ran out of dollars. The 349 billion got deployed very quickly, and so there were then further iterations of the program with further legislation by Congress. So the next thing that happened was that Congress passed and the president signed the Paycheck Protection and Healthcare Enhancement Act, and that pumped in another 310 billion for PPP loans, not quite doubling the original injection of money, but not far off it, sort of increasing it by virtually another 40%. So more money came in via that legislation. And then, so keeping in mind what I just said about the fairly rigid strings attached to these loans in order for them to be forgivable, the Paycheck Protection Flexibility Act was then passed and signed into law a few days ago, 5th of June 2020. And that both extended the covered period for the loan from 8 weeks to 24 weeks, meaning that authorized users of PPP funding for now up to 5 or 6 months will qualify for forgiveness, sort of give a longer runway, now, and going back to the public health situation, now that we're learning this isn't just going to be a 2-month experience and we're all back to normal and it's going to be a glorious V-shaped recovery and all that sort of thing. So recognition is kicking in that it's not going to be quite so smooth and splendid as all of that. And so covered period extended, and also some, I mean, not a great deal, but some increase in sort of flexibility for use of the funds. So a reduction in the strings attached. PPP fund spending will now qualify for forgiveness on more flexible terms. The 75% requirement for payroll has now been reduced to a 60% requirement for payroll. So still some problems there in terms of businesses that don't have large payrolls, but a measure of increased flexibility in the deployment of the funding that qualifies for loan forgiveness. And of course, going back to this point that that policymakers are beginning to realize that we are going to need longer term support for the economy because coronavirus and COVID-19 is not going away anytime soon. There is now a lot of chatter in Washington, D.C. about further emergency and stimulus packages. So the House Democrats, so Democrats control the House of Representatives, have passed a bill called the Health and Economic Recovery Omnibus Emergency Solutions Bill. And typical of America, there are staffers somewhere sat in on Capitol Hill dreaming up titles for bills that then have nice acronyms. And this one is called the HEROES Bill. And that contemplates another $3 trillion of funding. So that we go from $2 trillion to another $3 trillion, taking us up to about $5 trillion worth of funding. That particular bill is being kicked around at the moment in the Senate, and there's going to be a fight because the Senate Republicans control the Senate, are not so keen on the particular terms of that. So there's going to be a negotiation. But I don't think there's any question, particularly keeping in mind that we are in an election year here in the US, that something will come out of that in the wash. It's obviously going to be a question of how things play out in terms of the lobbying and which particular special pleadings get recognized, given partisan arguments between the Republicans and the Democrats on, who should be supported and who shouldn't be supported. But subject to all of that, one can anticipate a significant further injection of funding over the summer. So an awful lot going on, and we've seen this in a number of jurisdictions in terms of aggressive emergency economic measures. And I think increasingly a recognition in the US that there is going to need to be continued economic support to ensure that, or to try to ensure that a recession doesn't become a depression. But despite all of that, $5 trillion potentially of emergency federal support, not counting also state level measures where there's been state level money going into propping up businesses and propping up households, there are, of course, a number of warning signs. So sure, the government measures appear to have been reasonably effective to this point in keeping businesses and keeping consumers out of the bankruptcy system. So if you look at overall bankruptcy filings for the March 1st, May 31st period of this year, they were actually down compared to the same period, the comparable period in 2019. And on a week-by-week comparison within that period, March 1, May 31st, 2020, compared to March 1, May 31st, 2019, in some weeks they were down as much as 50%. So on the face of it, for the time being, government support for businesses and households has been reasonably effective because the bankruptcy numbers have not yet ticked up. So business bankruptcies filed in May 2020, sure, they were up compared to May 2019, so last month's numbers, but there the case counts, the way in which the numbers are reported, were heavily skewed by the bankruptcy of the Le Pain Quotidien bakery chain, which accounted for 104 of the 242 Chapter 11 filings in the US last month. So yeah, that was a business where each of the individual Le Pain Quotidien restaurants was organized through an LLC entity, and all of the entities filed, and then there was procedurally consolidated Chapter 11. They're all being jointly administered within the Bankruptcy Court. But because the numbers count each of those filings, each of the entities, it doesn't take into account the fact that actually what you have there is a single group enterprise. And so the numbers accordingly are skewed by that filing. And the reality is, therefore, again, the overall picture is that there hasn't been that much of an uptick, at least up to the end of May. But here's the big warning sign. The unemployment rate, which has flatlined through 2019 at around 3.5%, is now up in the 13 to 15% range, and there are concerns that could get up to sort of 1930s levels. And the really worrying sign is that the core unemployment rate, which measures sustained unemployment, as distinct from sort of temporary blips arising from COVID, folks being furloughed and then business starting up again and then being taken back on again, that core unemployment rate is rising very fast. So that's the first big warning sign. There are also very clear signs of stress in sectors that have been particularly affected by the crisis, particularly affected by shutdown, or that were already weak, over-leveraged, or suffering from debt overhang pre-crisis. So, no big surprises in terms of where the pain is really being felt. Non-essential retail was already in big trouble and is taking an absolute hammering. So JCPenney, Neiman Marcus, J. Crew, big brands that are already now in bankruptcy court. So those are three of the big instances of retail Chapter 11 cases in the very recent past. They're all now in Chapter 11. Travel, leisure, restaurants, all that sort of stuff, obviously problems. Just a few headlines here that I've pulled from the Wall Street Journal and from the New York Times in recent days. Which airlines are most in danger of going under? There are big worries about American right now. That filed Chapter 11 back in 2012, came out the other side, leaner and fitter. But there are worries about that. There are worries about Norwegian Airlines, obviously not a US airline, but those are the ones that I'm seeing that might be in trouble. A lot of hotel capacity in New York City simply been closed down and not reopening. Brands like Hilton laying off a lot of their corporate staff. Le Pain Quotidien on the restaurant bakery side of things, the retail leisure restaurant side of things. I already mentioned that, and that's an example of a case that's already in bankruptcy. So big pain there for fairly obvious reasons. The car rental giant Hertz, you may have heard, has filed for Chapter 11 very recently. And based on amount of liabilities, that has gone into the top 10 US Chapter 11 bankruptcy filings of all time. The number one, of course, in terms of liabilities is Lehman Brothers, but Hertz is in the top 10. And Hertz has been trying to do some very interesting things, fueled by some of the craziness that's been going on the stock markets here, seemingly funded by aggressive day traders. Lots of concern on Wall Street about something called the Robin Hood app. But Hertz was an example of a business that filed Chapter 11 and its stock went through the roof. There have been 2 or 3 of these. So despite the fact it filed Chapter 11, people were piling into the stock, which seems to bankruptcy folks like us counterintuitive, because as I'm sure you'll know, in a Chapter 11, because of the absolute priority rule, stock, generally speaking, is going to get wiped out, and what you're going to see is the creditors take over the business. And so a lot of furrowed brows and scratching of heads when we saw Hertz's stock go up exponentially. The theory now is that apart from short covers, so people that have been betting against the stock, anticipating bankruptcy and then having to close their short positions, that it's been day traders, folks that can't bet on sports right now because that's not happening, sort of sat in quarantine on this Robin Hood app, piling into penny stocks, sort of try and drive up the stock and then sort of get out on the rising curve. And so we saw last week in Delaware, which is where the Hertz rent-a-car case is going on, an application by Hertz to the bankruptcy court to seek to get permission to issue some of its unissued stock, but something like $2 billion worth of its common stock, to take advantage of this rising stock price as an alternative way of doing its DIP financing. Now, a number of us were horrified by this, thought this is just completely nuts, bearing in mind the stock will get wiped out in the bankruptcy process. But they tried it, they got approval from the bankruptcy court to do it, but then just today I read that the SEC has said there is no way in hell that we are going to allow you to issue stock when you are disclosing in your prospectus for this stock that it is worthless essentially on day one because of what's going to happen in the bankruptcy process. So the SEC has more or less told them they can't do it, and they're now scrambling around to do sort of more traditional DIP financing. So Hertz has been an interesting case, not only because of its size, but because of some of the things that have been going on with its stock and in terms of its financing options in the bankruptcy process. Another sector that has been severely impacted, and this has been not just COVID, but also because of where the oil price has gone, has been energy. So extraction oil and gas in Colorado, Haleakala Solar, which is a Hawaiian solar energy company. They have both filed Chapter 11 in recent days. So plenty of warning signs, and here, apologies for the tiny text. This is just something I picked up off the ABI Institute's website the other day. There is now a sense that we are 30 to 60 days from the sort of COVID-19 filing cliff, that we are going to see a very severe uptick in bankruptcy filings very soon, lagged to what is going on. So everything we've been seeing so far, what I was mentioning about the May numbers a moment ago, is really just the calm before the storm, and that a tidal wave of filings is coming. And I think the big one there to look out for is the unemployment rate. That is historically a very reliable predictor of increased business and consumer bankruptcy filings. I commend to you a paper by Ben Iverson, co-authored with Jared Elias and Mark Rowe. Mark Rowe, I think, will be known to many of you, a Harvard bankruptcy law professor. That paper called Estimating the Need for Additional Bankruptcy Judges in Light of the COVID-19 Pandemic. It's available on SSRN right now, and that makes this point, amongst others, that the unemployment rate is a reliable predictor of increased business and consumer bankruptcy filings. So while certainly this sort of $2 to $5 trillion that the federal government's pumped into the system has succeeded thus far in flattening the curve of bankruptcy filings, we're expecting a tidal wave of filings in the coming months. I saw Bob Keach from the American Bankruptcy Institute say today that the expectation is we're now 30 to 60, a month to 2 months away from a severe uptick. So the tidal wave is coming. And forgive me that sort of cheesy depiction of the tidal wave. So what are we going to do in the bankruptcy system? I started off at the outset by saying, and I noticed from my timer that I've been banging on now for about half an hour, and I'm going to sort of wrap up in the next 10 minutes or so by talking about the bankruptcy system's response in particular. But I started out by saying, really, the story, and that reflects the sort of allocation of my time, has been about emergency economic measures, things like the Paycheck Protection Program, the CARES Act, and so on. But now we're going to get this predicted uptick, which the employment rate is telling us is coming and coming very soon. What about the bankruptcy system? Now, of course, the US bankruptcy system is robust. The Bankruptcy Code has good tools. The Bankruptcy Code has been seen as an exemplar for other countries to emulate, to look at, to figure out whether some of the tools that we use in the US might be tools that are of adaptation in other jurisdictions. And of course, US ideas, have been to a large extent exported through the World Bank, through the IMF, through the Washington Consensus. And whilst not everybody has sort of copied out Chapter 11 of the Bankruptcy Code, certainly those ideas have been influential. It's been a system to look at and consider, bearing in mind that it is a very good system. So of course there are good tools. There's Chapter 11. It's a world-leading business rescue and restructuring system. Also added to Chapter 11 very recently is a new subchapter 5, which was brought in by something called the Small Business Reorganization Act. And that new subchapter 5 of Chapter 11 was effective before the crisis really took root. It came into effect on February 19th of this year. And that was a policy response to a long-standing problem in the US that whilst Chapter 11 is indeed world-beating and extremely useful when it comes to restructuring large and mega businesses, it has been not so successful as a tool for restructuring small business debtors. And that largely has to do with some of the structural and legal institutional features of Chapter 11 that add a significant amount of cost that don't make any sense for small business debtors with relatively modest balance sheets. So what the new subchapter 5 does is it streamlines Chapter 11 for small business debtors, originally when enacted with debts of not more than roughly in the region of 2.7 million, of which at least 50% must arise from commercial business activities. So conceivably, you could have individual sole proprietors filing Chapter 11. You wouldn't have to be an entity necessarily. And so, you might have personal household debt as well as business debt. So for those folks, you've got to meet this 50% threshold as well as being within the 2.7 million debt ceiling. Now, the one thing that the CARES Act did to the Bankruptcy Code was it increased the debt ceiling for this new subchapter 5. So it said we might need this streamlined new Chapter 11 as a tool to deploy to meet the COVID crisis and the impact of the COVID crisis. So the debt ceiling in subchapter 5 was increased by the CARES Act to 7.5 million, and that is sunsetted, so it's only for a year until March 27th, 2021. The idea being we're going to expand the capacity of subchapter 5 to see us through the crisis, and then we'll review in a year's time. But as of now, we will revert to the 2.7 million debt ceiling next year. Now, under subchapter 5, the debtor operates as a debtor in possession, as it would do under Chapter 11, but the difference is it's under the supervision of a subchapter 5 trustee who is tasked with facilitating development of a financial plan. So it's a kind of a hybrid model. I guess maybe a little bit like an English corporate voluntary arrangement, where you have an insolvency practitioner involved, but the debtor is still running the business. So, or maybe a bit like the Canadian reorganization system where you have a monitor. It's a little bit more like that. So a trustee is involved, but it's not a trustee like a bankruptcy trustee in a liquidation case who takes over the management of the business and the assets. There is no requirement under subchapter 5 for a creditors committee or for a full disclosure statement. So that's taking out some cost. And there is also a very interesting feature that enables the small business debtor to cram down all impaired classes if you meet the confirmation requirements and still retain equity. So there is a real cram down threat here that is designed to help forge consensus. The absolute priority rule doesn't apply. That gives incentives for the debtor to file because their own investment, they have some chance coming out of bankruptcy, keeping that investment, the financial investment, but of course their emotional investment that they will have put into their small business over the years. So the absolute priority rule doesn't apply, and you've got a real cram down threat that enables you, or at least in theory, it's hoped will enable you to work towards a consensual plan with the help of the D. Now, clearly there is a very strong possibility that this new and as yet not thoroughly tested system of subchapter 5 will be stress tested, and there could be lessons for other countries contemplating MSME style reforms coming out of the US experience in the next 6 months to 12 months with subchapter 5. So finally, just a couple of words about what bankruptcy courts are doing. They are using existing law in innovative ways. So we're not seeing any really significant adjustments to the code apart from this increase in the debt ceiling for subchapter 5. But we are seeing use of existing law in innovative ways. So in the Pier 1 imports case, for example, there's been something called a mothballing order developed. So that was a case in which there was a filing in February because of supply chain issues with the entity's inventory. This was the early impact of the crisis in China. They then couldn't liquidate the inventory in bankruptcy because all of their premises had to close down on the lockdown. And they sought and obtained an order suspending their bankruptcy proceeding under the abstention power in section 305 of the Bankruptcy Code, which had the effect of freezing their ongoing rent payments. So in bankruptcy, you are obliged under section 365 to continue to pay the landlord pending a decision to assume or reject the lease of the premises. But effectively what courts did here, which was unprecedented, was they used section 305 to suspend the bankruptcy case and effectively just stop the clock altogether and mothball the case. And other courts have followed this sort of Pier 1 practice. Now, of course, there are concerns about macro spillover effects into commercial real estate. But I guess that's just the way bankruptcy works, right? You can use bankruptcy to deal with the debtor in front of you and the stakeholders in front of you. It is not macro resolution like a bailout. So, of course, there are concerns about the impact of these orders on landlords and on their issues and on their servicing. But it's been one creative thing that bankruptcy courts have done under existing law to help debtors. There are concerns, however, about the system and about how it will cope. There's concerns that there will be less liquidity in the debt finance market. So I commend to you a paper by David Skeel, the Pennsylvania academic, which you can get on the Brookings Institute website, which talks about that. There has also been some glitches with the P loan scheme that I told you about earlier. Under SBA rules, that cannot be used by already bankrupt debtors. So if you've already filed, you are barred under SBA rules from taking out a PPP loan, which to many of us seems utterly ridiculous because the PPP loan will be a useful tranche of DIP finance. And that problem has actually led to a raft of injunction applications in the bankruptcy court seeking to enjoin the SBA to consider these applications on arguments that they're exceeding their authority under the CARES Act, which actually intends these loans to be available to debtors in bankruptcy. And so we've seen some litigation. There's been mixed results. Some bankruptcy courts have granted injunctions, others haven't. But it's been an uncertainty that's now leading to needless and costly workarounds. So courts are basically allowing debtors to dismiss their cases to get the PPP loan and then refile their cases once they've got the PPP loan. So that's been an interesting issue with some courts trying to, again, help out the debtors by trying to force the SBA to make the loan. There are also huge concerns, finally, about bankruptcy court capacity. And again, the Iverson paper that I made reference to, the Skeel paper, are talking about that. Very big concern that unless we get more judges to deal with the forthcoming wave of cases, that the courts will clog up. This will slow down cases, leading to more liquidations. We'll have markets saturated with distressed assets, and that will in turn drive down asset prices for everybody. So big worries about distressed asset markets and how they will respond if bankruptcy court capacity is not addressed. So I think that's the one to watch in particular. No movement yet from Congress on that, but a lot of people are shouting about that from within the bankruptcy system, from within the Bankruptcy Academy. Get ready for this wave by creating a lot of temporary judgeships to deal with the issues. And I will stop there. My 45 minutes is up.
Thank you so much, Professor Adrian. Such a fantastic talk by you. Now, I would request the audience to keep posting your questions. We have one comment by Dr. Paul. He says, Dr. Paul, would you like to speak?
Can you hear me? Yep.
Oh,
Hey.
Hey, Adrian. Yeah, I was just wondering that if the tranche of shares is actually sold and used for dip financing, effectively that's going to just end up in the hands of creditors, isn't it?
in some of the report, yes. Yeah, what would happen, and this is why we were all so curious about what they were doing. I mean, clearly they're not a subchapter 5. They're a mega case in Chapter 11, and so in terms of cram down, bargaining in the shadow of the law, the negotiation is going to take place in the shadow of absolute priority, and that's absolutely right. The stock, or at least the investors who buy the stock, are going to get wiped out because the creditors are going to be the only folks in the money. So right, and not surprisingly, therefore, to me, the SEC have said there's no way we're going to allow you to peddle this junk.
But can you see other people trying, however, and the SEC giving some form of leave if, say, it is actually has a reason other than simply to peddle junk?
I think it would have. I think there would have to be real confidence that it was 100% plan. I think that's the view here. In other words, that the problem you've got was a temporary problem, say because of COVID. If you could ride through the problem, get liquidity on reasonably long maturities, you'd be able to offer everyone 100 cents on the dollar, and therefore coming out the other side, the equity could be worth something. I think that would be, if you could make disclosures. I mean, the prospectus for Hertz was hilarious. I mean, it literally was saying, 100 times in 2 pages, please buy this stock, but please understand it's worthless on day one. So that's what really got the SEC's dander up, I think. But I think a case in which it was more carefully crafted, there was some prospect, because you could say, look, the underlying business here is sound. The problem is COVID. Here's our plan for how we get out of that. We do have liquidity in an exit financing package that's giving us a long enough maturity to get out of this and rebuild this business. The stock may therefore be worth something. I think that might be something where you can have a conversation with the SEC. I mean, interestingly, Mary Walroth in Delaware just went with, it was a 363 application, and she went with Hertz's plan. So she kind of went, well, and you know how it goes in the US, oftentimes the court will defer on a business judgment standard, right? If you really think this is something you can get away with, who am I, a bankruptcy judge, to interfere with this? And I don't think there was any objection from anybody. And so she rolled with it. I've not seen a transcript of what she said, if anything. I imagine there might have been some kind of bench ruling. It was last Friday. But she kind of almost sort of passed the buck to the SEC. And they've said no. But I think, along the lines I've just outlined, there might be cases, where you could get the SEC on board.
So we have next question by Susan. She's asked, doesn't having a trustee involved raise the cost of insolvency resolution, and doesn't that hurt more for small business?
Oh, this subchapter 5. Yes, very good point. So it's interesting. Your choice as a small business at the moment now is subchapter 5 is really threefold. You can do a regular chapter 11, and there's still a regular small business chapter 11 you can do, which was the law prior to February 19th, 2020. It's on a different timeline from chapter 5, so that's an option. But with that option, you're just a standard debtor in possession. You don't get a trustee. So you can do a Chapter 11 without a trustee. You can do Subchapter 5 with a trustee. Alternatively, you can just try and work something out outside of bankruptcy law, either under federal receivership law or under state receivership law or under state assignment to creditors sort of law. And historically, because of the costs of the Chapter 11 system for small businesses, what's tended to keep them out of Chapter 11 to this point has been the costs that your questioner is sort of referring to. And what's tended to happen is basically those cases have stayed outside of the bankruptcy system altogether. Now, to the point, now you have this option. The idea, I think, is that the trustee is supposed to be light touch. And whilst, of course, the trustee will be remunerated and the debtor's attorney will be remunerated, they're trying to strip out all of the rest of the cost. So creditors committees and additional attorneys, strip that out. Complex disclosure statements, strip that out. And the other thing that's happened with the Subchapter 5 trustee, very interesting opinion just the other day out of the Eastern District of North Carolina, you can, under the Chapter 11 system, if you're a trustee, so you're in Chapter 7 doing a liquidation, apply not only to the court to have your own remuneration approved, but you can also seek to employ other professionals, which of course adds further cost to the bankruptcy process. And what the judge in the Eastern District of North Carolina did the other day in the Subchapter 5 context, he was faced with an application by the Subchapter 5 trustee to employ an attorney. And he said, no, we're not doing that. The whole purpose of this system is to be streamlined. And whilst we recognize there will still be some cost, we're trying to keep those costs to a minimum to make this work. And so we're not going to grant routine applications for Subchapter 5 trustees to appoint a whole bunch of other professionals. And I think where that's going to go as well is that when under Section 327 to 330, the courts end up reviewing the costs, because ultimately all remuneration for professionals has to be court approved. Firstly, their retention has to be approved up front. You know, can they be involved in the case at all has to be approved. And then on the back end of the case, how much they get paid and whether they can get paid what they billed, that also has to be approved. I think we're going to see both limits on the Subchapter 5 trustees being able to retain counsel, thus reducing cost up front. And we're also going to see very tight controls by bankruptcy judges on what the trustees and debtors can claim. Now, of course, that could have other impacts, right? Could have other downsides in that it might drive professionals out of the system. That will be the concern on the other end of it. You want good professionals to be attracted into the system to make it work. But I think the judges are already on their way to trying to strike some kind of balance to make this as cost effective as possible. So great question, and I hope that goes some way towards answering it.
Thank you so much, Professor. Any further questions from the audience? So one from my side, sir. What's your take on PPP? Like, once the 8 weeks are over and the PPP fund has been used to pay the employees, like what's next if the sales haven't revived?
Well, so the first thing on the flexibility legislation, firstly, the scheme is open for application until June 30th. And so the possibility of getting top-up loans is currently there. And with the greater flexibility now that you can deploy those funds for up to 5 or 6 months, there is some margin in that system still for it to provide some relief. But you're quite right in the assumption of the question that a big concern in the USA right now is, once those programs start to, one, run out of money, and two, come up against their expiry deadlines, that, what's going to happen next. And I think that's basically the Heroes Act stuff. It's still being argued about in a sort of tit-for-tat battle on the Hill right now between the House Democrats and the Senate Republicans. But I think, the clock is ticking, and they're very conscious in an election year that there is going to need to be, within that additional $3 trillion of relief that the House Democrats are proposing, a further set of programs that are going to be designed to help to continue to provide liquidity to small business. I mean, clearly there are massive concerns right now, I think, about with people that really know their stuff. People like Jerome Powell and the Fed and those folks, they're going to be concerned about, what happens once you've kept some of these debtors afloat, but you've had rent moratoria, and you're going to have problems for landlords, which are then going to flow into the commercial real estate space, and that potentially becomes sort of non-performing loans in the banking system, right? There are going to be worries about contagion effects within the economy as a whole. So I don't know what those measures. The short answer is I don't know what they're going to do yet, vis-a-vis PPP in particular. But there are arguments going on right now, and there is very clearly an understanding on the Hill and in the U.S. Treasury and the Fed that we're going to have to do more so to prevent sort of widespread contagion effects in the economy, the bankruptcy system, and to prevent us tipping into a depression.
Thank you so much, Professor.
Great question.
VV Anand, who has Mr. VV Anand, would you like to ask your question? Meanwhile, we have one more question in the chat box by Mr. Ashutosh. He asks, in spite PPP and other financial stimulus, will there be a moratorium on fresh filings if companies or firms fail its creditors?
Yeah, that's a really good question, and I'm not fully up to speed on the Indian response, but as I understand it, and I hinted at this, I think, in some of my remarks, India has been trying to choke off access to the bankruptcy system and figure things out outside of bankruptcy, which of course is one way of preventing a massive capacity problem in the bankruptcy system. There is no signs at all that we will in the US deny access to the system. As you know, US Chapter 11, it is one of the most accessible bankruptcy systems in the world, if not the most accessible. There is no insolvency requirement to file a Chapter 11 case. There is a very, very low threshold for you to be an eligible debtor to file a Chapter 11 case. And I really don't see, in terms of US culture, legal culture, and business culture, there being any need to choke off access to the bankruptcy code. I think it will be seen as a reliable and robust tool, sort of as it was in the immediate aftermath of the financial crisis. And therefore, I think the conversation, the critical conversation, will be much, 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 much more about making sure that the bankruptcy system has capacity. And so, if you read the Iverson paper, in some scenarios, he's modelling that the system might need up to as many as 250 additional judges. And keep in mind, there are 94 districts and currently around about 400 judges, so that will be a significant increase. So they're talking about People that are shouting at Congress about this are talking about the need for temporary judgeships, maybe short-term 1 year. I mean, at the moment, bankruptcy judges serve for 14-year terms. Could we create some 1-year temporary judgeships? Could we move capacity from districts that are rural, less impacts, into areas where there are more impacts? We already have very high Chapter 13 filing rates, and our judges definitely need some assistance, sort of here in Chicago. Can we recalibrate the system capacity-wise to move second judges from courts where there are less impacts to courts where there are more impacts? So creative thinking about bankruptcy court capacity, creation of more judgeships, creation of temporary judgeships, reassignment of judges from courts where there are less impacts to particularly urban courts where there are greater impacts. That I think is going to be the conversation, rather than moratoria on filing or trying to somehow choke off access to the system. I think we're going to continue to see the system calibrated much as it is in terms of access to it. So great question.
On that note, sir, like you already know that in India the filings have been suspended with regard to defaults related to COVID. So what do you think? Is it give a breathing space to business because that's the purpose, or will it do more harm because of a large number of filings maybe post this period?
Well, it's a really interesting question. I guess it's going to depend, right, how far your emergency economic measures can help those businesses that are now being kept out of the bankruptcy system, and you sort of flatten the curve that way, right? That's the big question, because as you say, the possible danger is that eventually you have to lift that moratorium, and at that point you see a massive flood into the system. It's just a huge spike, at which point then you potentially have the same kind of capacity problem. So it's interesting to see like different jurisdictions taking different approaches. So I mean, we can't really predict with any certainty, given I guess that we don't yet know epidemiologically how this is going to play out. And whilst of course any kind of curve flattening buys time for the science to catch up, that's going to be the big question, right? I mean, assume we do have a vaccine by say January that can genuinely be put out there and scaled and manufactured, and we can then get the public health aspect of it completely under control. So in that kind of world, if by the second quarter of next year, you can prop the system up in the meantime with stimulus, maybe the moratorium will work out well. But I don't think there's a right answer. I think it could be interesting to come back, say, in a year's time and compare what happened with what's happened in your country with what's happening in America. It could well be it's just a complete wash. In your system, you defer the capacity problem by doing what you're doing now, and you can then figure that out because you've got longer to figure it out. Whereas, we've got to figure out the capacity problem in the shorter term, because I don't think the American system is ever going to countenance barring off access to it. It could be it sort of comes out as a rough wash. But obviously, in your system, you're going to have to make sure economically that you are keeping those businesses from failing outside of the bankruptcy system with no access to it. Fascinating question.
Points.
And I have no real answer for you.
Right. We have just one last question by Mr. V.V. Anand. He's asking that what was the rationale behind incorporating the condition of supervision by a bankruptcy trustee for Chapter 5 filing?
Really, really good question. The idea, I think, was about capacity, about making these cases work. The feeling is, your small business person, generally speaking, is not going to be a repeat player who's familiar with the system. And there needs to be some institutional counterpoint in there to the debtor and the debtor's attorney that can sort of look at this both from the perspective of creditors and also with a view to providing some capacity to the debtor to get us quickly to a consensual plan. So it has a lot to do with providing some sort of institutional check for creditors on the one hand, but also the way the legislation is crafted to have a facilitator there that could bring mediation skills to the table that would design to sort of help you get quite quickly to some sort of consensus among the creditors and the debtors as to a meaningful way forward. So the U.S. trustee, which is the overall sort of administrative oversight of the U.S. bankruptcy system, the U.S. trustee, sometimes confusing term, but the U.S. trustee is an agency within the Department of Justice that oversees the system. It's the U.S. trustee that appoints these folks. And in building the capacity of the Subchapter 5 system, they have been trying to get folks with sort of financial advisory experience, with mediation and negotiation experience, to try and put somebody in there who is going to be able to help a debtor to get round the table with their creditors and try to facilitate a deal. So that was kind of the idea, and rather than just sort of leaving it to the debtor and maybe the debtor's attorney, if the debtor was filing pro se, to sort of be stumbling around trying to do something, in a situation where that might not actually be that successful. So I guess it's kind of capacity building. Try and have somebody there who could be a consensus builder and help the court get the sense that this thing is progressing somewhere quickly. And under Subchapter 5, just by way of a footnote, you're on a 90-day clock. You have to file a plan in 90 days of the case. So the timetable is pushing you along, and the whole idea is to try and get consensus quickly. Again, great question.
Mr. Anand, I hope your question has been answered. With that, we don't have any further questions. Yeah. So, thank you so much, Professor. We are almost on time also. Thank you so much. It was a pleasure to have you with us. It was seriously, honestly, and pleasure.
As I say, it was a great pleasure to have joined you. I'm glad I was able to do this, and thanks again so much for facilitating it. And I've thoroughly enjoyed it. Thoroughly enjoyed meeting you virtually, and I wish you well with your further talks in this series.
Thank you,
Professor.
Yeah, thank you, Professor Walters. One thing that comes unsaid with these webinars is that you become part of the GIP family. It doesn't, so I hope that we have more to hear from you, and we will stay in touch. Thank you. Yeah, thank you, Professor Walters. Yeah, Urvashi.
Thank you so much. Just last note for the audience members that we'll be circulating the video and the PPT in next 24 hours. And thank you so much, everybody, for such an overwhelming response. Thanks once again, Professor. Thank you.